Right, good morning, everyone, as we head into European trade on Friday, the 8th of September. We'll have a look across markets and we'll see what is going on once we kind of go around some charts in a minute. But apart from that, I mean, dollar charges towards the longest weekly winning streak in 9 years. 8 weeks higher in a row, or 8 weeks in a row higher is probably better English, and the US dollar continues on its trend higher as yields have continued on their trend higher. Although heavy buying of bonds, heavy downside in yields into the close yesterday, which is interesting, has contributed to a bit of a pullback in the dollar, a bit of a pullback in stocks as well. So it's probably a bit of respite to markets, but overall, the trend is still the same, certainly on the US dollar, but yields had a lot of downside yesterday, which maybe is a bit interesting. But dollar up, continues to be up 8 weeks in a row off the back of expectations for interest rates to be higher for longer. Markets haven't believed the Fed, but the recent slew of positive economic data over the last few months, maybe not the last week or 2 weeks, but certainly over the last number of months, positive economic data showing a resilient US economy when a lot of the other economies are showing a bit of weakness. Especially China. China's yuan ends domestic session at lowest since 2007. We'll have a look at dollar yuan as well, with obviously struggles in the Chinese economy, plus them providing some support to the Chinese economy. So obviously monetary stimulus weakens the currency, increases the amount of currency in circulation, therefore increases supply, which increased supply without a match in demand is obviously a negative for the price of any asset. Really though, fresh information, not too much we can do. I mean, we probably need to keep an eye on Sino-US tensions between the US and China, as China have extended their bans on Apple products on iPhones. It was recently in government, but they have extended that as well, and that is not likely to be taken well by the US. Puts potential trade wars back on the agenda. Now that is a bit of an extreme conclusion just off the back of that, but certainly is not going to do anything to improve the relationship between the two countries. It can only go one way if they continue on with that, but that's nothing we can do about that just now. Let's see how that plays out in the coming days and weeks ahead. But over to the monitor, you can see bounce back in stocks. Asia Pacific stocks down across the board, which a lot of the time to do with China's negative economy. But US equity futures higher, European equity futures higher, yields slightly lower, which does provide some respite for equity futures. With equity futures, you get your Aussie and your Kiwi higher across the board. With your equity futures down, yields down, US dollar lower across the board. Japanese yen lower across the board. Normally when you see yields down, you see a bit of Japanese yen strength, but stocks are bid. Australian dollar, Kiwi dollar bid. Really no surprise that the Japanese yen is slightly lower, but markets not 100% in line with each other as we head into trade today, but certainly a bit of bounce back in stocks. Is there a bit of a bounce back throughout the course of the day today? With that pullback in yields, it certainly would not surprise me. Trend has been down on stocks for a while, and you know how stocks work. Any dips get bought. When this dip gets bought, is it today? Is it another day? Let's see how that plays out. But have a quick flick across here. You can see a bit of a pullback in the dollar, obviously uptrend the dollar, bit of a pullback, but Aussie, Kiwi, Euro, Sterling all popping slightly higher. Dollar Swiss, dollar CAD, dollar yen all pushing lower. Dollar yen's broken, had an attempt at breaking through this kind of double tops neckline that we were looking at. Potential for Bank of Japan intervention. They said on Wednesday that they did not rule anything out in terms of the yen weakening too much, or in terms of being able to stop the slide of the yen. So they don't rule anything out. That means currency intervention on the way if that chart continues higher. So markets seemingly reluctant for now to keep that pushing higher. Maybe the central bank doing a little bit to try and stop them from having to intervene aggressively. You can see the pullback in the dollar across the board, driven by this pullback in yields, and it's a pretty aggressive pullback in yields. I mean, they're still higher on the week for now, but pretty solid downside from the highs back here. A good 2% drop 10-year, 2-year. 2-year obviously decreasing slightly faster, but both of them moving lower like that is somewhat negative for the dollar, is a bit negative for the dollar, and that is a little bit positive for stocks. So you can see the bounce back in stocks, certainly across the S&P, the Dow Jones, the Nasdaq, and the Russell hasn't really managed to gather some of the gains that the rest of these have had, but still a bit of a bounce back nonetheless. The DAX is failing to create new lows. Just 3 days in a row it's struggling down at these lows. It is trapped in this recent range, but you have to imagine these highs are on to be attacked at some point today. Can we get above them and start to trend a little bit higher? I'm not so sure the ECB need to hike interest rates again. I would argue that all central banks are done hiking interest rates, unless inflation starts to pick up again off the back of those oil prices. But they're going to want to avoid crippling the economy, and the much further they go, they're going to cripple the economy. Certainly growth is starting to slow down across the globe. It's not a situation where you want to continue hiking interest rates really and absolutely destroy the economy. But the DAX, Euro stocks, the FTSE are struggling to make fresh lows over the last number of days. All of these look like they want a bit of a bounce back, but we're going to keep an eye on these over the course of today. I think being long stocks today, just on a risk to reward perspective from a bit of a short-term play, isn't the worst thing in the world. The economic calendar for today does not provide much information. Inflation from Germany is the final figure, so it's not your estimates, but bang in line with expectations, so nothing really to see there, to be fair. But 0.3% is still too high in terms of a monthly figure, so they still will want to get that down, but we'll grow at 0% unless the oil prices have much of an impact. You'd have to imagine that inflation will probably head lower, as 0% growth is certainly not a contributing factor to inflation pushing higher. Apart from that, you've had some GDP figures out of Japan lower than consensus, but hasn't really done too much to the currency. You had a little bit of a pop higher in the Japanese yen off the back of that. You kind of met back in the middle, so a little bit of nothing out of those GDP figures from China. A little bit later on, we do have the unemployment rate from Canada, and the Canadian dollar is struggling to avoid its slide against the US dollar. You can see the dollar CAD continues to trend higher. You have had a bit of a pullback in oil, as you can see, negative for the Canadian dollar, positive for dollar CAD. Come around to these employment figures, and if you have a look at this IVPMI was alright yesterday, but Bank of Canada, the central bank, came across relatively dovish. I mean, they're probably not going to hike interest rates again, judging by their comments on Wednesday, or back on Wednesday, and the dollar CAD, the Canadian dollar continued to sell off the back of that. Dollar CAD continues to push higher. You have to imagine, you'd have to hope for some weak prints a little bit later on. So I'm getting mixed up where I actually am. Unemployment rate today, 130 from Canada. Be hoping the unemployment rate is due to rise. Anything above 5.6% provides a fresh opportunity to get long dollar CAD, short the Canadian dollar. Obviously, you've got some contributing factors to that number, but with the central bank seemingly done, you'd be hoping for weak economic data to continue to push dollar CAD higher. Lower oil prices are a contributing factor to that. Weak economic data, lower oil prices, certainly a recipe for a sell-off in the Canadian dollar. But that's a little bit later on, 1:30 today. No economic data until then. Got to keep an eye on our charts, on our cross-asset correlation, and I see how these things open up in about 10 minutes time. So looks like stocks want to have a bit of a bounce back. Whether that materializes or not, we'll find out over the next few hours.